All right, so tonight is the Stockscores Foundation overview. This basically takes us through the material of the foundation section of the Stockscores Education Center. I used to teach this on a Saturday morning for 3 hours, but I found that people got a little tired of sitting in a chair in front of their computer for that long. So I've now split it up into 2 sections. So we'll do part 1 tonight, and then we'll do part 2 on Thursday at the same time. I am recording this, so you will be able to watch this as often as you like. So if it feels like I'm going through something too quickly and you don't understand, certainly you can ask me questions, but also recognize that you will be able to go back and watch it later as well. All right, so what we're going to do is really focus on the most important concepts of the foundation. This is not meant to replace the foundation because the foundation lessons are online. You can watch those, and there's more than 3 hours worth there. What this is intended as is a way to see it all put together and really pull out the most important concepts. So it's an overview, and I think it's helpful to just see how the different techniques and processes and concepts connect to one another in one lesson. And so my aim is to really get you set up for the application sessions that we're going to do next week. So next week we have the 3 market scanning sessions. And then for those who have taken the Active Trader course, there's also, you get a month of Active Live with the course. And so you will be able to participate that whenever you want. And that's important to know. I don't care if you do the Active Live next month or this month. That's entirely up to you, or 4 months from now, all up to you. So, but what I'm trying to do is establish the basis of what we're going to do. So what I want to start out with is just really talk some basics about stock charts. And I know that a lot of you are sort of familiar with stock charts and how they work, but for those who are not, let's just work through this. So first thing up in the top left here, you can see the it says 1095 day weekly chart. So that means this is a 3-year weekly chart. And these are called candles. They represent price and how it moved for that period. So in this instance, it's a week. And so on this particular week, the market opened there. Its low was just a little lower. Its high was a little higher, and it closed at the top of the green box. So we call that green box the body. And then if there's a long piece on the end, we call that a tail. There's a little tail on the bottom as well. Again, this is the high, this is the low, this is the open, and this is the close. Now this is a weekly chart, and you can see how time or how price moved over time. Going back into 2016, the stock was at 25 cents a share, and it eventually went into a nice upward trend and got up close to $5 a share, not quite, but close. And so the middle chart is volume. So how much volume did the stock trade for that interval? So again, this is a weekly chart. So in this week, the stock traded that much volume, which looks like about 2 million shares maybe. But there was times, like here, when it traded close to 20 million shares. And that's what you'll see as a stock goes up, it tends to trade more volume. There is a saying in trading that volume is the fuel of the buyers, and stocks cannot really go dramatically higher unless the buyers are there to push it up. You need lots of volume to push stocks up. Stocks can fall without volume, but to go up, they need volume. So that's a weekly chart. We can look at different intervals. This is a 10-day, 13-minute chart. And so this bar, instead of being a week, represents 13 minutes. And so when we're swing trading, we like to look at this chart. And then when we're day trading, we like to look at a 2-minute chart. So again, if you look in the upper left, you can see 2-day, 2-minute chart. And so this stock moved significantly in the course of half a day, and then at 1 o'clock it reversed and it went down. And it doesn't look a whole lot different than a weekly chart or a daily chart. It's just a very short time. Now this stock went from 70 cents to $2.30 all within a day. And so if you're a day trader, you can see the excitement that that brings, because in one day you have the same amount of movement that some stocks take years to do. If you think about percentage-wise, that's a better than 300% move within a single day. It also lost from the highs down to where it closed. It lost almost 50%, not quite, but close. So that's why we day trade, but obviously there's not many stocks that will do this. So I'm going to show you how to find them, but that'll come later. All right, so that's just a basic overview of charts. Just trying to think if there's anything else I should cover. So here is the date, 8th of November, the volume that traded for that day, and this is the volume for the previous day. So you can see this stock, nobody really cared about it. And then on this morning, it started to come alive, and within a few hours, 3 or 4 hours, it had gone up significantly. All right, so that's kind of the finish line, the stock chart, the idea that we can make money from stocks going in these nice strong trends. That's all well and good, but in order to understand my strategies and my approach to the market, I think it's important to understand a little bit of theory. So what I'm going to cover is the kind of thing that you would learn in your first year of finance class. So I have a degree in finance from the University of Calgary, and I can remember learning this stuff in my first Finance 101 class. I think it was called Finance 201, actually. And that is basically, let's begin with, why does stock price change? What is stock price? What does it represent? So stock price is based on the value of the company as perceived by the market. Now, what is a business worth? If you owned a business, you would say it's worth some multiple of what it makes for a profit. Private businesses tend to be worth 3 to 5 times their earnings, depending on how much they're growing. So a company that makes $100,000 a year, let's say you own a little restaurant or something, makes $100,000 a year. If you're trying to sell that, you're probably going to get 3 to 5 times earnings, $300,000 to $500,000 for that restaurant. The value of the restaurant equipment, the chairs, the tables, that's not really how businesses are valued. It's valued on the value of future earnings. And so there's a saying or a concept called the present value of future earnings expectations. So every company's in business to make money. This is today, right here. And then we have 1 year out, 2 years out, 3 years out, 4 years out, 5, 6, and on and on and on. And so when you're valuing a business, you will say, okay, well, $100,000 in 6 years, what is that worth? In today's dollars, well, it's probably worth $50,000 if you think about the time value of money. And $100,000 in 5 years might be worth $60,000, maybe $55,000. In 4 years, maybe 48. This would be 65,000 maybe. I'm just doing this really rough. 3 years might be worth 70,000. In 2 years, 80,000. In 1 year, you'd be willing to pay $90,000 today for $100,000 in 1 year, right? Think about it. If you took $90,000 and you put it in an interest-bearing account, $90,000 is not going to turn into 100. But if you could make 10% on your money, then it gets pretty close to 100. So the present value of future earnings expectations is what this is all about. And in order to really figure that out, you need to know the interest rate. So if you can get 10% on your money, then $90,000 in a year makes some sense. If you're only getting 3% on your money, then you wouldn't pay $90,000 today for $100,000 in a year. You might only pay $97,000 today for $100,000 in a year, right? So this isn't super important, but I just want you to understand the basic concept. And so the things that determine what a stock is worth in the future, or today rather, is the value of future earnings, the uncertainty around those earnings, and the general mood of the market. Now, in order to figure out what a company is going to make a year from now, 5 years from now, 10 years from now, we need to have information about that company's business. and how much uncertainty is there in that calculation. We can predict pretty well what a company is going to make, like Microsoft, in a year, because Microsoft is a very established business. We got a pretty good idea all the products they sell, and analysts are pretty good at guessing what these companies will make. However, if you talk about a very junior gold mining stock who makes really no money, then it's pretty tough to make that calculation because you're guessing. Will they find a deposit of gold? If so, they could make a lot of money in 10 years, but in the absence of making a major find, it's pretty hard. So what the stock market's job is to figure out what the present value of future earnings is. And in the stock market every day, people buy, people sell, and they're arguing about what they think the company is worth. And that's really what's important to understand, is every time you buy a stock in the market, you are casting your vote that you think the stock is worth more than what it is trading at. And on the other side of that transaction is a seller who thinks that the stock is worth less than what it is trading at. And one of you is wrong. You should always be humbled by that. On the other side of your trade, when you buy, there is someone on the other side of that trade who has a different opinion than you do. And one of you is wrong. Now, you might have different time horizons. Someone could be a day trader selling the stock and really concerned about what's going to happen in the next hour, while an investor is more concerned about what's going to happen over the next year. So we can all be winners in some ways, even if we're wrong at that moment. So why do some stocks move faster than the market? Well, some stocks have really significant change in their fundamentals. We call these alpha stocks. They are moving on their own story, and they can move quicker because they have dramatically improving business fundamentals. So if a gold miner discovers gold one day in one of their projects, you would expect that stock would move very quickly relative to other gold stocks, and certainly relative to other stocks in general, because they have just found some information that dramatically improves their ability to make money in the future. Now, it doesn't matter if the information is accurate. What matters is what the investment community perceives to be the truth. The truth itself doesn't matter in the short term. It only matters in the long term. In the short term, and that could be months actually, all that matters is perception, which is why we see stocks make these dramatic moves like cannabis stocks, right? They went like this, and then the perceptions couldn't really keep up with reality, and since then they've done this. Now they're still higher than when they started because the fundamentals did get better, but the market's perceptions got way ahead of what the fundamental value was. And that was because people were speculating, they were gambling in some ways, they had a very optimistic mood. There's a little bit of that crowd mentality of piling on to a stock. So these things all contribute to irrational pricing. As traders, irrational pricing is awesome. As investors, long-term, buy and hold, irrational pricing is frustrating because you could be the person buying that cannabis name up there and then be sitting down here stuck with a big loss. But as a trader, we can buy here and the stock goes parabolic and we can sell when it breaks its upward trend, and we get to take all the meat in the middle, which can be quite dramatic. So what is the key to finding winning stocks? We want to find those stocks that are trading on new information, that have significant fundamental change underway, and capitalize on the trend that will develop when there is that significant fundamental change. Now, what drives it is information, and what we have to understand before we go any farther, because I should have said this on the last slide, is that the stock market isn't fair. There's always going to be some people that have better information than others, and those people, when they act on that information, will do well in the market because they have better information. And what happens is when those well-informed investors have better information, they act on it, they create abnormal behavior in a stock's trading pattern. So a stock could be kind of trading quietly, and then it comes alive, and the volume could be quiet, and the volume comes alive. And that abnormal price and that abnormal volume tells us that some people have some new information. And so when we get stocks that behave abnormally after a period of low volatility and breaking through resistance, we often get upward trends. And we can apply this concept to day trades, swing trades, position trades, long-term trading. It works on all time frames. So whether you want to be a day trader or a long-term investor with my method, this concept works in all areas. Now, it doesn't work all of the time, because sometimes the people that make this trade back here at the start, maybe they're wrong. Maybe there was a rumor and the rumor turns out to be wrong and the stock goes right back down again. And that does happen. Happens at least 30% of the time, I would say. But if you get the pattern right, if you really understand what I'm going to teach you about finding stocks breaking from predictive chart patterns, then you can have a pretty strong winning percentage. And with good risk management, not take big losses when the market is wrong, or when you've taken a trade that proves to be wrong, then you can do quite well. All right, move along. Almost all stocks that beat the market start their market-beating trends with abnormal activity. Not all abnormal activity leads to market-beating trends, and so therefore we need to qualify the trades that are worth taking. This is a super important slide, so I'm going to say it again. Almost every stock that beats the market, if you go look at stocks that have done well today as day trades or over the last year as investments, if you go look at all of them, you will find that almost all of them, I'm going to say 90 to 95%, will start their market-beating trend with abnormal price and abnormal volume. The problem that we have is that not all abnormal price and not all abnormal volume leads to a market-beating trend. We need to have ways to qualify the trades that are worth taking. And that is where chart patterns come in. Chart patterns help us qualify what abnormal trading activity is important. And if we understand a few concepts that I'm going to teach you next, you can really start to read the chart patterns and be able to put the probability of success higher than if you just looked at abnormal trading activity by itself. So, two important concepts. One is the inflection point, and then we're going to talk about the 6 elements of chart patterns. So an inflection point occurs when price changes direction. So if you have price is going up and it stops going up, you have an inflection point top. Price is going down and it stops going down, you have an inflection point low. So this is an inflection point high, this is an inflection point low. That's all it is. Peaks and valleys. Good way to understand it. Now, the longer the trend into the inflection point, the more important it is. So in other words, if you have a market like this, these inflection points are not as important as this one. Try to draw that where you can see it better. So again, if you have so this inflection point here is more important than this inflection point because the length of the trend into the inflection point is longer for this one than it was for this one. Now, how do you define an inflection point? When I first started teaching, I would just say, look for peaks and valleys. But then I started programming my strategies into a computer, and so it became necessary to define it mathematically or with logic so that the computer could do it. And so this is what I do. Remember, we use candlestick charts, so if we have little bars like that, if there are 4 candles to the left that are lower than this candle and 3 candles to the right, then I call that an inflection point high. By the same token, if I have 4 candles to the left and 3 candles to the right, that are higher than the low of this candle, then I have an inflection point low. Pretty simple, but it's a nice way to get a computer to do that, because all the computer has to do is say, if the low of the previous 4 candles is higher than the low of this candle, and the low of the next 3 candles is higher than the low of this candle, then call it an inflection point. And so you wouldn't really be able to call this an inflection point until 3 candles later at a minimum, right? So that's an inflection point. If we look on a chart, it's pretty easy to see. I want everyone to look at this chart and try to find peaks and valleys where there are at least 4 candles to the left and 3 candles to the right that fit those rules. I'll let you ponder it for a second, and then I'll start marking it out. All right, so I'll get out my little drawing tool. So let's do the obvious ones first. So those are the ones that really stick out. And then we can get a little pickier, like this one right here just barely has 4 candles to the left and 3 candles to the right. But the computer would say, hey, that's an inflection point. Same with this one. It's a little harder when you have to really be specific. That one there, this one here, this one, this one, this one, this one, this one, that. Hopefully you get the idea. Okay. So this is important because we're going to start connecting these dots, these X's. We're going to draw lines across them to define the chart patterns. Now we can see those inflection points on a 2-minute chart like that, but we can also see them on the daily chart. So now I've shown you how to do it once. Ponder that image in your head and just kind of with your finger sort of identify the ones that you see as inflection points, and then I'll draw them on there. Okay, so again, the obvious ones are just the really high peaks and valleys. And then there's maybe less obvious ones like that, or like that, like that. But these ones are more important than the little ones. So for example, there's a little one right there. It actually had a nice trend into it, but it didn't last very long on the right side. You want the major peaks and valleys. Those are going to be the best ones. But now imagine if I just drew a line across these inflection points, I've just drawn my first chart pattern that is an upward trend. We'll get into that in a moment. Before we start drawing lines across the inflection points, we need to understand the 6 elements of chart patterns. And they are support, resistance, optimism, pessimism, price volatility, and abnormal activity. So let's go through each one in turn. Starting us off with support. Support is a floor price on a chart. It is found at an inflection point low or drawn across a series of inflection point lows. And the more times that that line can be touched by inflection point lows, the more important that line of support is. I want everyone to notice this right here. Drawing support is not an exact science. You're trying to guesstimate that. So I could say there's inflection points like that, and I could draw a line across those, but it's not perfect. This one kind of went a little below, this one maybe a little above. You're trying to draw the line that best fits as many inflection points as possible. So I have drawn a trend line of support, but I could also draw horizontal lines of support at each inflection point. Now think a little bit about what this means. I'm going to draw this a little bigger. So let's say you've got a stock that's going up, and then it stops going up and starts to go down for a while, and then the buyers say that's down far enough, and they start pushing the stock up again. So we will say that this is support. We have an inflection point. We call that support. But what does that really mean? If we remember that this is all about price, okay, so price is on this axis, and this is time. What it means is that at that moment in time, the buyers and sellers in the market did not think that the stock was worth less than that price. Price was moving down, and when it got to a certain point, the buyer said, you know what, we think that this company's fundamentals are worth more than this price, let's call it $10. And so we're going to buy the stock aggressively. And at the same time, the seller said, you know what, I think price is getting a little cheap. I don't feel like this stock is worth less than $10, and I'm not willing to sell it for less than 10. And so you have some equilibrium between the two sides. The stock stops going down and starts going up. Now that's important because those people that are voting in the stock market, the buyers and sellers who are casting their vote every time they make a trade, they have just said, they have just stated that that stock is not worth less than that value based on the fundamentals that they have. So it represents a floor for the fundamentals. And that's important because if we were to go down through that floor at a later date, it implies that someone has some information that justifies taking a lower price. So the reason we want to understand support and resistance is because these are lines in the sand that the market has drawn, which reflect buyers and sellers' perception of fundamental value. So when we look at this stock on a very short-term basis, we can see there was very strong support here. And then we had lines of support like this. And eventually one of those lines of support was broken and the stock then went down. The reason it was broken there is the seller said, all right, high enough. We're going to sell this stock aggressively because we don't believe the company's fundamentals are worth this price. And that usually happens with the smartest, or I'm going to say the smartest, the most well-informed investors will make that vote first. And then as more and more people learn about it, and as the psychology of the market changes, you get the downward move. Look at that on a long-term chart as well. So let's draw our support. Got horizontal support like this, but we also have trend line of support, right? Cut across that inflection point, quite a few different inflection points there. And notice that when that trend line of support was broken here, it telegraphed that. Eventually, that stock went down, but it was the people who knew the most that started to sell. Maybe even here, when you had this break of horizontal support right there, that was another strong clue. So now you can start to see, hey, I can use just this one concept to know when to sell stocks. Wow, that's amazing. I never knew when to sell. But now, just understanding support and how to draw it, you can start to have a methodology for selling that cannabis stock that went from $1 to $5 and then started to go down. And instead of holding it today at $1.50, you could say, hey, I got out at $4.50. Not at the high. We don't try to get out at the high. We don't try to buy at the low. It's actually the most unprofitable way to trade is to try to buy the lows and sell the highs. We just want to get the meat in the middle. All right, next concept is resistance. So resistance is the ceiling price. So just as support was a floor price, resistance is a ceiling price. It represents a perception of fundamental value again, but in this case, it's the upper value. It's the maximum amount that people have been willing to pay over a certain time frame. And all we do is we draw a line across inflection points. And just like support, the more times that inflection point is touched, the more inflection points that touch the trend or the line, the more important it is. And the higher the peak, the more important it is. Not an exact science, we're just trying to guesstimate a little bit. All right, so I can draw a resistance here, and here, and here, and here. And I can also draw a trend line of resistance like that. So stock broke through resistance, it went up. Stock broke through resistance, it went up a little bit. Stock broke through resistance, it went up. Stock found resistance, and it couldn't get through on the next try. Little bit of a clue that something's wrong. and then it started to trend lower until it broke its downward trend of resistance there, and that perhaps was the bottom for the day. Well, it ended up being right at the end of the day there. Okay, we can look at that on the longer term chart as well. So I can draw a resistance like this, here, 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 here. And I would say the most important one was this one, because that's when a strong zone of resistance that had been touched a couple of times was broken with something we'll talk about soon, which is that abnormal price action. And then we had a little sideways trading here, and we broke it. Up it goes. Little sideways trading, and we broke it. It went up a little bit, but it started to peter out, and now our trend line of support was broken here, and we started a new downward trend with downward trend lines of resistance. So at this point, hopefully you're saying, hey, all I need is a pencil and a ruler and the vision to see what I need to see. And that's true. The thing is you have to take this conceptual knowledge and make it personal knowledge. So what is the difference? Well, conceptual knowledge you got to think about. So, I think most people, when I show them this, they say, okay, that makes sense. But it takes practice to get to the point where you don't think about it anymore. And so we're going to practice together. We're going to do a few market scanning sessions, and I'm going to try to do a market scan tonight as well. But ultimately, it takes practice on your part to start to see these things. And so if you understand the concept, realize that you still have to personalize the knowledge so that you don't have to think about it anymore. And that's why I always tell my students, take time to practice. Don't start trading tomorrow. I've only given you enough so far to be dangerous. You have to get to know this stuff really well and practice it. All right, next concept is optimism. So optimism happens when the buyers are in control, inflection points are rising from left to right, and the steeper the rise, the more optimistic investors are. So if you've got a stock that's doing this, then you've got inflection points that are rising from left to right, and therefore you have optimism. You can draw a line across them and say optimism. Here the line isn't rising quite as steeply, so it's still optimism, but it's not as optimistic as it was back there. So looking at the chart again, I can start with my inflection points, and I can see that they are rising from left to right, and therefore I have optimism. They stopped rising from left to right in here, so I no longer have optimism. Optimism has gone. Guess what replaces optimism? Pessimism. Talk about that in a second. On the longer term chart, same thing. Inflection points are rising. Therefore, we have optimism. You want to own stocks when there is optimism. You want to avoid stocks when there is not optimism. Now we've got another simple concept to keep us out of bad stocks and focus us in on good stocks. Obviously, the next thing is pessimism. I think you know this is going to be inflection points that are falling from left to right. The sellers are in control. So let's go to the chart. We had our first falling top there, and then we had lots of them afterward. And so we have pessimism. Think about what's happening. The buyers push the stock up, they're strong. Then it falls back a little bit. And the buyers push the stock up again, but they're not as strong as they were the last time. They can't push it to new highs. And so we get a falling top. And here again, the buyers push it up for a few days, actually a few minutes, but they can't push it as high as the last time they pushed it up. And so we get a falling top. And so anytime there's falling tops, it's really a sign that the buyers are not as strong as the sellers. Right? You can look at that on a longer term chart as well. So we have optimism here, and then we switch to pessimism because the tops are falling from left to right. So this is a time to own a stock. This is a time not to own a stock. Don't want to own during times of pessimism. Same here, pessimism. Want to wait for bottoms to start to rise. Breaks through resistance. So with the inflection point and optimism and pessimism, we can draw trend lines. Trend lines are drawn across inflection points that rise or fall over time from left to right. A trend is made up of a directional move followed by a more minor counter move. So we go up, we pull back, we go up, we pull back, we go up. The trend is defined by these pullbacks because that's what creates the inflection points that we can draw our line across to say that is an upward trend. We can do the same thing with downward trends. We can say the stock is going like this. We've got falling tops. We draw a line across them. There's our downward trend line. Every time the buyers had some power, they couldn't be as strong as the previous time. Have some power, not as strong as the previous time. Have some power, not as strong as the previous time. Again, not an exact science. You draw the line that best fits as many inflection points as possible, paying particular attention to the strongest inflection points, the ones that have the most significant patterns. So let's draw some trend lines. Start with our inflection points. Draw a line, draw a line across them that best fits. It's not perfect. We're a little far away from this one, but we touch this, we touch this. Then on the downward trend, just draw a line that best fits. Now with this program, I can actually draw a straight line. You can see that that one fits at that point, but earlier I could have drawn the trend line like that. And notice that the trend line was broken there, and then we still went higher afterward. That happens sometimes. Just because a trend line is broken doesn't mean it will go down. It may mean that it's just going to go sideways for a while. There's your downward trend line. But it's actually amazing, and the more you draw these trend lines, you'll see how amazing it is that once you define a trend line, how often a stock will come up to the trend line and get stuck, or come down to the trend line and bounce. It is one of the most powerful tools, and yet also one of the most simple. So I can draw a trend line like that. I can draw a trend line like that. I can draw another one a little steeper. I can draw one like this, that. Draw a steeper one here. So you might be wondering, how am I drawing these lines so quickly? That's a little tool that you can get for free. It's called Zoom It. And if you just Google Zoom It download, Z-O-O-M-I-T, it will take you to the Microsoft website. I think it's called the Microsoft Garage or something. And I would go to the Microsoft site so you don't get any garbage viruses or something. And you can download it for free from Microsoft. And what it allows me to do is I just hit Control D on my keyboard, and then I can just draw on the screen. Now, if I want to change the color, I hit B for blue, make a blue line, red. If I want to make a straight line, I hold down the Shift key, draw a straight line. Put it back to green, hit G, back to green. Or sorry, I was using orange, wasn't I? Orange. There we go. So it's a nice little tool. Again, I'll write it down here. It is Zoom It. It also allows you to zoom in on the screen. But, you know, if you're doing your market scans in the evening and you want to visualize and see these trend lines and that sort of thing, just install Zoom It. It's like a really small little program. And then you just hit Control D and you can start drawing with your mouse. Now I'm using a laptop that has a touch screen, so I'm actually drawing with my finger, which is even better. It's really easy. But I'm doing it with my mouse right now. I don't draw very good straight lines with my mouse. All right, next concept, overbought, oversold. So what does that mean and how does it relate to trend lines? Well, we can use our trend lines to help us see whether a market is overbought or oversold. Overbought means it has gone up too fast, too quickly, Oversold means it has gone down too much, too quickly. And very simply, overbought simply means that we've run away, up and away from the upward trend line. Oversold means we have run down and away from the downward trend line. And that is when there is the most emotion in the market. And typically, investors are acting irrationally, and the market will eventually come back to the trend line. And this is another one of those crazy rules that doesn't make a lot of sense, but you will see it happen over and over in the market. So I can draw my trend line across that. Up here, we are overbought. We have run away from the trend line, and price usually comes back to it. You can do it in downward trends as well. So we are too far below the trend line, price is going to come back up. Too far below, price is going to come back up. So when you hear me talking, and when I do market scans and things like that with you guys, you'll often hear me say, it looks a little overbought here. All I'm talking about is it's far above its upward trend line and it needs to pull back to it. And we actually have a strategy that takes advantage of that called a pullback play, where we look for stocks that are in upward trends and we wait for them to pull back to their trend line and buy them down there rather than chase them up here. So let's do it here. So here, a little overbought, we had to come back. Here, a little overbought, had to come back. We came back and we bounced. However, the bounce failed and we ultimately broke down and started a downward trend. But again, I can draw that downward trend line and say, oh, a little oversold, we came back. Oversold and we came up. On the daily chart, draw my trend line. We run away, we come back. Run away, we come back. Draw my downward trend line. We're starting to come back here, but it needs more time. So in order to draw a trend line, you need two things. You need a starting inflection point, and you need another inflection point to draw your line, to define your line. And then you just draw it across those and then continue it onward, extrapolate it out into the future. All right, next element, price volatility. So price volatility is really talking about how much the stock's price is changing relative to its history. So it's not enough to say, hey, this stock went up 3%. That sounds really volatile, or 10%. Because a penny stock moving 3% is not really that big of a deal. But a Microsoft type stock, a large cap stock, moving 3% is a big deal. And so when we talk about price volatility, it's all relative to the stock's price history. And you see there are some terms I have, convergence or divergence. So if we were to have a pattern and we draw a line across the bottom inflection points and a line across the top inflection points, if those lines are converging toward one another, in other words, the lines are coming together, then we have diminishing price volatility. If those lines are diverging from one another, then we have increasing price volatility. Increasing price volatility is a sign of investor uncertainty. Investors aren't sure what the stock is worth. Price is changing rapidly. Decreasing price volatility is a sign of investor confidence. At this point right here, the buyers and sellers agree about what that stock is worth. Now, when I say confidence, that is not meant to represent something good or bad. It just means that they agree that the price is that. There is no agreement here. Price is all over the place. So there is uncertainty on this one because we have diverging volatility lines. And where we have converging lines across tops and bottoms, we have agreement. Buyers and sellers say, yeah, shake hands, we agree. That'll become really important in a moment. So let's look at this chart here. I can draw a line across the tops, I can draw a line across the bottoms. Sorry, this one thing about Zoom is it doesn't let me freehand very well. Or here I can draw a line like this, or here I can draw lines like that, or here. And notice what happens when you break from low volatility through resistance with abnormal activity. Up she goes. So now you're starting to see the formula. If we want to be good at picking the stocks that have abnormal activity, we have to find those that are breaking through resistance from low price volatility. Look at another chart. I guess we'll come back to this in a second. Next element is abnormal activity. This is our last element. Abnormal activity in terms of price and volume. So if you have a stock chart and it kind of looks like this, and then all of a sudden you have that, it doesn't take a rocket surgeon to look at that and say, hey, that looks abnormal. And if the volume kind of is like this most of the time, and then the volume spikes, again, looking at that, it's fairly obvious. So visually, abnormal activity is just the bars of price and volume action that stand out on the chart. However, because we have thousands and thousands of stocks to look at in the market, we can't just rely on the visual inspection of the chart because we don't have that much time. So we get the computer to do it by using statistical analysis. And that is really the key component of many of my Stockscores trading strategies, to look for statistically significant abnormal behavior. And so I've written some algorithms that do that. Some of them I learned in university when I was studying finance a long time ago. I've modified some as well. So if we go back to this chart, there is statistically significant abnormal price movement there, and the volume was also statistically significant. Now, it doesn't look like that volume is very tall, does it? Because compared to these, it's quite short. But you always have to compare abnormal activity with what came beforehand. And this volume here was actually higher than it had been going back over a year. So it was statistically significant. It was abnormal. This was actually abnormal as well. This was abnormal. Volume spiked, volume higher than it had been, price action strong. Here we have abnormal price and volume. So when you get abnormal price and volume through resistance, from optimism, from confidence, you have a great trade. I'll say that again. When you get a break through resistance, with abnormal activity, with optimism, from compressing volatility, from low volatility, you get good things. Not always. Sometimes the market makes mistakes. Some people get bad information and act on it. Sometimes the information they have was a rumor and it turns out to fail. Sometimes you have investors speculating about something coming. So for example, with biotech stocks are out there trying to develop new drugs, and they have a new drug, they test it. There's something called a PDUFA date, which is the date when the FDA puts down or announces their ruling on whether the testing is working, effective or not. And the market can move up in anticipation of the PDUFA date. Whoops. Okay, it can move up. But when the news actually comes out, maybe it's here, trades huge volume, that's when the stock can really start to move. But the people speculating here, they're kind of placing their bets on that. With a mining company, people will speculate that the company is going to find whatever they're looking for. But until the news actually comes out, we don't know. But I will tell you, if you wait for the news, you're probably buying in late, way too late, relative to those who speculated much earlier. Here you can see with abnormal activity, when you're talking about day trading, the stock will trade abnormal volume all day long compared to normal. And the price action gets very abnormal relative to what happened. So it's not, when you're day trading, it's not really specific to the single candle necessarily. It can be just generally abnormal all day long. So we can take those things and we can put them together and come up with different patterns. Now I'm going to sort of give you the highlights here because there's a whole video lesson on the patterns, and I used to teach each one individually and gave them all names: ascending triangles, descending triangles, pennants, bullish, bearish pennants, bullish flags, bearish flags. The name doesn't really matter. All of these patterns, not almost all, have a few things. Primarily, they're about compressing volatility. So an ascending triangle pattern looks like this. It's got ascending part is the optimism, rising bottoms, and the triangle is formed by the fact that the volatility is compressing. So this ascending triangle is actually my favorite pattern. It's quite reliable. When you get a breakout from an ascending triangle, you get a strong upward trend, usually. We had a breakout by the overall stock market from an ascending triangle a few days ago. And so the market's been moving up. So if we look at patterns, there is a rectangle consolidation back here. Basically, a rectangle consolidation is just a little sideways trading range where the tops and bottoms are kind of parallel. There is a bullish flag here. So for a flag, you want to move up, and then you want this little pullback, which makes the flag, and then you look for the break of the flag. We have a pennant right here. Draw a line across the tops, draw a line across the bottoms. It kind of looks like a pennant. We have another pennant right here, but this time we get a downside breakout. That tells us that the stock is likely to go lower. We have a little bearish flag right here with a breakdown. Then we have trends. We have an upward trend. There's one there, and then there's one here. And then we have a downward trend like that. All right, let's take a look at another chart. We'll draw on it as well. So again, got a rectangle consolidation there with a breakout. Got a little pennant pattern there with a breakout. We've got a little rectangle, another rectangle. And we have an upward trend. And then the upward trend got a lot steeper, which means that the buyers are more emotional. They're maybe pushing that stock up irrationally fast. Let's look at some more patterns. So here we have a descending triangle with a breakdown. Then we have a rectangle consolidation with a breakout. Have a little flag with a breakout. I think those are the major ones there. Some people call this a rounding bottom pattern with a break. I'm not super fond of that, but you'll read about that in books. Here's another one. I've drawn the lines on here. So there's your ascending triangle with a breakout. Here's another ascending triangle with a breakout. Away she goes. Another one, rectangle consolidation here with a break. Another little sideways trading with a break. Downward trend line with a break of the downward trend line. Here we have, this is called a bottom fishing pattern. When you break the downward trend line, step 1, you build a rising bottom. Step 2, that's optimism. And step 3, you break through resistance. I call that a bottom fishing pattern. All of these are covered in the chart pattern lesson. I'm just giving you the quick and dirty version here. So here's some flags. Stock goes up, pulls back, flag, breaks for the flag, up it goes, pulls back, flag, breaks the flag, up it goes. And then you start to build falling tops, and you have a descending triangle. Now remember I said that right now you're getting conceptual knowledge and you're saying, okay, that makes great sense, but you probably won't see it yet. It'll take some time to see these patterns, and that's all about personalizing the knowledge, making it your own, and that just takes a little bit of time. More patterns, flag, pennant, breakout. Here's a long sort of rectangle consolidation with a break. But the theme is pretty common or simple. It is looking for breaks through resistance from low volatility. The only exception to that on these charts is a flag pattern where you're getting a break through this little bit of resistance, but it's not really low volatility. It's just kind of a pause in the trend. So we go up, whoops. We go up for a while, and then we have a little pullback. That's the flag, and we're looking for a break of this line right here. Break the line, okay, we're going to continue higher. Flag. It's just, I call it the pause that refreshes, to quote I think it's this advertisement for Sprite or something. It's kind of what these flag patterns are all about, the pause that refreshes. All right, let's talk about price channels. So a price channel occurs when you can draw parallel lines across tops and bottoms. So there's your trend line, and you can draw a parallel line across that. And guess what? It gets predictive. It gets to the top of the channel, it gets stuck, it pulls back. You want to be a buyer down here, seller up here, buyer down here, seller up here. So we use that sometimes. I don't really build my strategies around that, but it's something to have a good understanding about and be aware of. So here's the S&P 500 showing a nice upward sloping channel. Gets to the top of the channel, pulls back, gets to the bottom of the channel, goes up, top. You know, you just see it. It's not perfect, but basically you don't want to be a buyer when you're at the top of the channel, and you don't want to be a seller when you're at the bottom of the channel, because there's a good chance it's going to bounce until the channel is broken. All right, so I've been trading for 30 years now, and a lot of things are very much the same. Abnormal activity is still a great indicator of a stock that is going to outperform the market. The stock market still isn't fair. There's still some people that get better information than others. The greatest thing that has changed is that the presence of computers in trading is really important now. Computers are programmed to take advantage of human psychology. You'll often hear me say that human beings are predisposed to fail in the stock market. What I mean by that is human beings are idiots with their money. They chase after strength because they get greedy, and they run away from weakness because they have fear. And computers, really the programmers of the computers, which is some of the big institutional funds that have PhDs in psychology and math and physics, they see these patterns and they take advantage of them. And so what's different today than maybe when I taught this course, say 10 years ago, is that now it's more important to get into a trend early. And so in the old days, I would wait for this nice ascending triangle to form and buy the breakout. Nowadays, I'm actually more interested in this, which is a break of the downward trend from a rising bottom and buying in there, rather than wait for the stock to get all the way up there and build the ascending triangle, because the market moves faster, and if you wait, you're kind of a dinosaur. So you got to be a little more aggressive in the patterns. And so now I'm more interested in buying breaks of downward trends. The only exception to this is day trading. With day trading, because it's such a short time frame, I still want the ascending triangle patterns to build, the breaks from low volatility to build. But when I'm investing longer term, I'm more interested in this pattern than I am in this. We're going to do some market scans a little bit if we have time, but that's something to keep in mind. All right, let's talk now about risk management. So your number one goal in trading is not finding the right stock, not knowing when to sell. It is capital preservation. If you run out of money, if you blow up your account, then you can't trade anymore or invest anymore. So the number one thing we do is preserve our capital. And that means we don't take foolish risks on each trade. We take a position size that reflects our risk tolerance. So let's go through a little exercise here. Let's say this was the pattern, and this was the breakout candle, and that's at $10. And we look at the chart and we say, where is support? Well, it's at the last inflection point low. Let's say that's $9. What's the difference between the entry price, $10, and support, $9? It is $1 a share. Okay? So, what is your risk tolerance? How much are you willing to lose on any one trade? Well, if you, let's say you have a $20,000 account, you might say, well, you know what, I'm not willing to lose more than $100 on any one trade. So your risk tolerance is $100. If the risk of the trade is $1 per share, then you can now size your position to buy 100 shares. The risk per share is $1, your risk tolerance is $100, you're willing to buy 100 shares. All right, now, the difference between your entry price or your entry signal price and support price, we call that risk, or we shorten it to R. And when we talk about that same space measured upward as the stock rises, we call that reward. And we can measure it upward again. More reward. Measured upward again. More reward. So all I've done is I've taken that same space and I've just extrapolated it higher. And so we can say this is our entry price. This is 0 value. Down here we are at a risk of 1, which we call -1 RR. RR stands for reward for risk. When we're up here, we are at 1 plus 1 RR. Here we are at plus 2 RR, and here we are at plus 3 RR. What that means is that if the stock goes up to this point, we are making 3 times our risk. Because this was our risk, and we've got reward times 1, times 2, times 3. We're making 3 times our risk. That is the risk-reward ratio, and these are the risk-reward lines. And you will see me draw those lines all the time. If you watch my YouTube videos, you'll see me put those lines on charts all the time. That's all they're based on. Now, I had to have a drink of water there, sorry. Let's say that's our pattern, and this is our risk. If we buy it here, and then the stock goes down really fast, and we don't get to sell it till down here, we've actually lost -2 RR. This is -1, this is 0, this is +1, this is +2. So just because we set our risk amount at the low point, the last inflection point, doesn't mean we're going to sell there. Some strategies, you're actually better to give a much wider stop or a much wider risk limit where your loss might be -3 RR, -5. Believe it or not, with some day trading strategies, you are actually more profitable to set your stop at -5 RR, which is way down, than you are at -1. Believe it or not, the average profit doubles, it's times 2, if you have this wider -5 RR stop versus a stop loss at -1. That's hard for some people to believe because obviously if you take your loss way down here at -5, you're taking a much bigger loss. However, the probability of the stock going all the way down to -5 is much lower than going down to -1 before it goes higher. And some stocks, they'll give you a nice entry signal and they'll go down -2 and then they start to go up. If you had stopped out at -1 and it's up at +3, you missed out on it. Now, I haven't talked a lot about order types and what a stop loss order is. I know some of you know that already, but I will. I just wanted to give you a quick little lesson on where the RR lines are drawn. All right, so let's use this as an example. So this stock gave an entry signal right here. because it made what I call an action candle. An action candle has abnormal price and abnormal volume, and it did so from low volatility. So my entry price would be here at $1. And I probably put my support down here at 70 cents. And therefore my risk is 30 cents a share. So if we take that space from here to here and we extrapolate it outward, we can start to see what our risk reward ratio is. So this is 1, 2, 3, 4, all the way up here. Now this is a day trade. That is how I used to teach risk reward lines a few years ago. Now I've changed it. Now, because I want computers to do all the work for me, I actually define my risk, my R, as the difference between the close of the action candle and the low of the action candle. It's a much narrower definition of risk. Rather than going down to the inflection point, which is way down here, I would define my risk as this amount. However, I still am going to put my stop down below the floor. It just means that my stop is at -2 RR rather than here at -1. So you might wonder, why would I do that? Well, the reason is because I want these lines to be tighter, because we're going to use these lines for some of our exit strategies. And if the lines are too wide, we don't get out at an effective price. Okay, we'll get into that eventually. We're going to probably not do exit signals today. We'll start our next session with exit signals. But anyway, that's how I define risk reward lines now. And that's why I say sometimes we'll take a bigger loss than a -1 RR. Could be -2, could be -4. I tend to go to the last inflection point low still, but I just define my risk reward lines narrower, mostly for my profitable exit rather than the losing exit. So looking at this one, which is much longer term, I'm going to define my RR lines like this. I might have my stop down here, which is a -1.5, but my risk reward lines are much tighter. And there's your risk. I'm just drawing these freehand, but you get the idea. That stock is up 1, 2, 3, 4, 5, 6, 7, 8 times risk. This is risk. We probably take our stop loss order at a loss at -1.5 down here, but we're making an 8 RR gainer on that one. So basically we're risking 1.5 to make 8. That's a good trade-off. Take that bet any day. All right, so now we're at exit signals. I think I'm going to pause there. I've got a few questions, and then we're going to do a couple market scans just to give you a hint of what's going to come next week. We'll try to find some stocks to buy today. All right, so first question. How can we define abnormal volume using volume moving average? You can't really. I mean, you can, I guess. So if your moving average of volume says average volume of the last month is 1 million shares, and you have a day when it trades 1.5 million shares, that's 50% above the average. So it would make some sense that that is abnormal, but that's not how I define it. I don't use averages. I use linear regression. It's a much more accurate method, and that goes on in the background of all my indicators and on Stockscores. So, next question, do we enter the trend when we break the flag pattern, or we wait to break the last pick before the flag pattern? We enter the trend when we break the flag, or we wait to break the last pick before the flag pattern? Well, okay, so depends on the strategy. So I think the question is this. Let's say we have a pattern like that. That's your ascending triangle. There's your breakout. That's the buy signal. And then it might go up, and then it might come back in a flag and then break the flag. We can buy more there. That's called scaling. We'll talk about that on Thursday. But our original entries here, we're just simply adding to our position because there's a flag. We might buy more here on this flag break. Okay. So I don't see any more questions. So what I'm going to do now is jump over to the Stockscores website, and I've logged in already, and we're going to run a market scan. So I'm going to go to the market scan tool. My computer's getting a little bit overwhelmed with the video that's being recorded because it's such a large video file. So that's why it's running a little funky here and slow. I'm hoping it will get better. It's really struggling right now. I think what I'm going to do, just so that this will run better, is I'm going to close down PowerPoint, and we'll just run, that's helped already. All right, so what we're going to do is we're going to run the Abnormal Breaks Canada scan first. So this scan looks for stocks making abnormal pattern break, or abnormal breaks. We have to determine if it's from a good pattern. So we're going to go through these in the slideshow tonight. Slideshow takes us through these charts one at a time. I've got my chart set to a 3-year weekly chart. And if I like the 3-year weekly, then I can take a little look inside to see how the daily looks. So first thing is, let's take what we've learned tonight. So we have a downward trend line. Actually, first of all, we have, oh, it's not letting me draw in here anymore. Arg. Okay, hold on, I got to get my drawing tool back. Just give me a second. Okay, so it should work now. Let me try this again. Okay, first we have inflection points. Also have inflection points here, right? So let's draw a line across these ones. That's your downward trend line. You can see we've got little rising bottoms, very short term, and we've broken the downward trend line. Now this is the weekly chart. Let's take a look inside and see how the daily looks. So I can click on 6 month, and now I see the daily chart. I can make it a 1 year, and I see the daily chart. So it still looks pretty good. It's got this downward trend line. I don't love that it's got this resistance over here, because the distance, if we buy it here with our definition like that, that distance is only about 1 RR before it's going to hit this resistance zone. So what it means is that it may take some time for this trade to work. So I think on the longer term weekly time frame, it's pretty good. On the daily, it's okay. It's not awesome. If I give this a 6.5 out of 10, it's almost a 7, but let's go on to the next one. So now that I've got this slideshow working, I just hit the right arrow key, and I can just cycle through. What I'm looking for are abnormal price breaks from good patterns. Now I can see abnormal price break here, breaking through resistance, but I also see quite a lot of volatility there. So I want to take a look inside. So I'm going to take a look inside this chart, go to the 6 month, or go to the 1 year maybe. And now I can see, okay, sideways trading range, pretty choppy, not really good low volatility. I do like the abnormal price action. I do like the abnormal volume, but because it was quite volatile before, there's a good chance it will pull back before it goes higher. Why? Because this volatility tells us that investors have some uncertainty. So I'd give this one a 6.5 out of 10. And the main problem is that it's a little too volatile. Next one. Okay, I don't see any kind of a breakthrough resistance on this chart, so I don't like that. Our formula is break resistance from low volatility with abnormal activity. Here I've got a break of this resistance line. I'm still below this one. Let's take a look inside the 6 month. Sorry, I should do 1 year. So I've broken this. I see that there's some resistance here. This is a really tall candle, and it's going to get up to here, and it's probably going to get stuck. And my risk reward potential is only about 1.5 RR. And I want at least 2. So I want my RR potential up to the next level of resistance to be at least 2, and it's not there. So next one. I don't see a good pattern here, so let's run this scan now on the, US market. So now, because I want to go through them a little quicker, I'm going to use the gallery viewer. Gallery viewer allows us to go through 10 charts per page and do that. So you know what, I'm going to actually change my default chart first because I don't like these weekly charts for these really crazy moves. So what I'm going to do is I'm going to pull up any chart. This is a little trick you got to learn. Microsoft, just pull up Microsoft's chart. I can go down to chart options and I can change it from weekly to daily. 3 years, I'm going to change it to 8 months. And then go down to the bottom, create chart. What I've just done is I've set a new default chart time frame. So now when I go to market scan and run this scan, so we're going to run the abnormal breaks US. We'll run the scan. View in gallery. Now I'm looking at daily charts. I'll still want to look at the weekly if I like the daily, but it's just some of these stocks had such big moves down in the last 3 years that it was hard to see. All right, so this one, SLS. You can see the abnormal price action. You can see the abnormal volume. This stock has fallen a long way. It looks like a company that really fell apart. I think this is okay. It's got a lot of pessimism to overcome. It's a bit of a long shot, but it traded huge volume today. It traded 52,000 times. It was up 43%. So I think it has potential, but it's a bit of a gamble. Maybe 50-50 chance of working, but if it works, it could make a lot. And that's how I would look at it. All right, so as I cycle through these, I'm looking for patterns. I'm looking for breaks from low volatility. We're going to practice this next week, but here's a beautiful bottom fishing pattern. So I've got a stock that was in a... my drawing tool died again. Hold on a second here. Not sure why this happens, but it does happen sometimes. Okay, so downward trend line, broken here. That's step one in a bottom fish. Then it builds the rising bottom, that's step two. And then it breaks from the rising bottom, that is step three. That is a pretty perfect bottom fishing pattern. It's got good volume, not great volume, good price action, not great price action. So I like it. Let's take a look at the weekly chart on this stock just to see what the big picture looks like. That also looks pretty good. So I give this a 7 out of 10 actually. I did this earlier and I missed this one. I didn't write it down. I probably was rushing a little bit, but I like this. 7 out of 10. So I'll go through these fairly quickly because I don't want to go too much longer and I got a couple questions to answer. But I will stop when I see something that I like. So TiVo, kind of been sideways here for a while, breaking. I can click on the chart, by the way, and make it bigger. Breaking from that sideways trading, volume coming up a little bit, so that's good. Let's take a look at the 3-year. So now I see if I blow this up, to blow it up, just click on the chart. And I can draw a line across those, something, I have to hit a keystroke to make that drawing tool work, and it's Control D, but for some reason it keeps crashing on me. Maybe because my machine is overwhelmed. So there's your downward trend line. We're just starting to tickle through that. I'd like to see it make a little bit more of a gain through the week. Then it'll have a stronger weekly candle breaking the chart. But I do think this is a little bit interesting. So I'd give that right now a 6.5 out of 10. But if it goes up a little more by the end of the week, it could turn into a 7. Here we've got stock breaking through resistance from rising bottoms. That's pretty good. The failing is that there's no abnormal volume. So that lack of volume means I'd give it a 6. So this one, breaking the downward trend. Little break there. Volume doesn't look all that strong, but that is the weekly chart. Let's take a look at the 6-month daily chart. A little bit volatile. See this volatility here? That's not quite awesome. I'd give that a 6.5. The weekly chart's pretty good. Just might take some time for this to work out. So as we go through market scans next week, we're going to do this 3 nights next week. I'm going to just I'll be repeating the same concepts over and over and over again. Breaks from low volatility, breaks to resistance, looking for rising bottoms, abnormal price and abnormal volume. And it doesn't matter whether you day trade, swing trade, position trade. That's kind of the formula. So the nice thing is, if you learn how to position trade, you can take that knowledge and transfer a lot of it to day trading. Now, day trading has some extra things that we do because it's faster moving. But conceptually, when it comes to the chart pattern, it's kind of the same. So here's AUTL. Just lacks volume on the break, so I would say a little worried about that. I want to get through all of these just so I can show you some others. Here's DBI. So it's breaking from this sideways trading from some optimism. It's got a lot of resistance here. Sorry, I don't think you see what I'm drawing. One moment, please. All right, so it's got a lot of resistance from this that's going to hold it back, and you can see not a lot of extra volume there, so it's not quite good enough. The price action isn't quite strong enough. So it's got some signs of life, but I don't think it's great yet. All right, so I'll just go through and pick out any that I actually like. I'm going to try to do this fast. And then if you have any questions, you can punch them in now. We'll try to wrap up with a few questions. We're getting into some of the higher price stocks now. So this is a nice ascending triangle pattern. The concern I have is it's already up a lot. So let's take a look at the 3-year weekly chart to see. I like to get in on things kind of at the ground floor, and it feels like this is a little bit late. Look at how long the stock has been trending upward. It's been trending higher for all year. If I owned the stock, I'd probably buy some more. That's a scale in. Again, we'll talk about that on Thursday, but I don't think I'd initiate a position there. I'm not saying much right now. I'm just looking at the charts, going through them. Now you notice I'm going through these pretty quickly. It's because I have personalized the knowledge. So it's like I don't even think about it anymore. For all of you, you are still at the conceptual stage. So maybe the concepts make sense, but you got to practice. And until you've practiced, you won't be able to go through them quite as fast, but it doesn't take that long. It's really a matter of repetition. The more charts you look at, the quicker you're going to be. So if you do 1,000 charts in a weekend, you're going to be faster than the person that does 1,000 charts in a month. But most humans are pretty good at seeing patterns. It's how we protect ourselves, right? And the more you can look at these things, the better you're going to get at seeing the patterns. All right, that was it. So we're done. All right, so I'm going to take some questions, and we'll wrap up, and we'll resume our talk. We'll resume our talk on Thursday. So next question. Average time for a rookie with absolutely no experience to become proficient enough to be a profitable day trader, weeks or months? I would say minimum 3 months. Not because the concepts are difficult, but because you have to get good at thinking quickly. And so you can't be thinking conceptually, you have to be personalizing the knowledge, and that just takes practice. And 3 months, I would say, is a minimum. It could take longer. You've given stocks you have scanned a rating out of 10. What rating out of 10 do you buy? Anything 7 or better, and I don't give stocks 10s ever. Very rarely do I even give them an 8. 9s, I don't know if I've ever given them a 9. So it's really about 7s and 8s. 6.5, I might turn into a 7 if the things improve. 6s. It's really about probability in my mind. So I've looked at lots of charts over my life, and if I give it a 6, I think it's got a 60% chance of going higher, or being a good trade, where it's not just about going higher, it's working, it's about whether it makes you enough to compensate you for your risk. Because I said earlier that there was that one stock that had a 50-50 chance of working, but it could make 5 times risk if it works, whereas if it loses 1 times risk, or maybe 2 times risk. So it's still a good trade. That's the concept of expected value, which is, we'll probably talk about that on Thursday. Can you show an example where you would put a stop loss for 2RR? Well, I guess we could look at some of the picks we made tonight. So what was one that I said was good? EXPR. I think EXPR was probably something like that. So let's go to EXPR. And if we think about our, sorry, it's very frustrating that I have to keep using this method to start up this application, but I do. Okay, so if we think about the height of our candle that's breaking out, it's that tall, right? I would put my stop probably just down there because that's my last inflection point low. So this is -1 and this is -2. So there's an example where you would have your actual stop loss at -2. Now we'll talk about exit rules on Thursday, so don't jump too far ahead on me yet. But that's the basic concept. Next class. How important necessary is having larger screens for viewing charts? More than one screen necessary? I can day trade from my laptop, but it's more work because I have to flip back and forth and I don't see things as easily. I got to work harder just moving from one application to another. So the benefit of having multiple screens on your computer is that you can put all those charts in front of you without having to do anything more than move your head. I always tell people, learn how to trade first, learn how to manage your emotions, be disciplined, learn the rules. You don't need multiple screens to do that. Once you're proficient in understanding the rules and maybe you start making some money in the market, then you can go out and buy a more powerful computer or get multiple screens, because now you can justify it with the profits from the market. And I would say doing so will make you more profitable, but you can't be profitable if you're not disciplined. You can't be profitable if you don't understand the rules. So don't go spending money on hardware until you've got that other stuff figured out. For a lot, you ignore even high breakup candles. Sorry, Darlene, I don't know what you mean by high breakup candles. So maybe elaborate on that, or send me an email and then I can help you by email. Maybe that would be better. I'm not seeing any more questions, so maybe I'll just let Darlene email me about that. I'm happy to help, and if it's something that I think will help everyone, I will try to talk about it next week as well, but I just don't understand what you mean by that term. So, okay, I'm going to leave it at that. We have gone exactly 1.5 hours, so it's perfect. We will resume this discussion on Thursday. I make a video of this, so I will give you the video link as soon as it is up and ready. And I will talk to you all on Thursday. Do some market scans if you can, look at some charts, practice a little bit, some of the things we talked about. Try to go through some of the foundation lessons. Anything you can do to sort of let this stuff sink in, because remember, it's got to become natural where you don't think about it anymore. I will talk to you all on Thursday. Have a great night. Bye for now.